Bell. But I do want to turn back to the major market action today. So Chance Finucane, Chief Investment Officer at Oxbow Advisors, joins me now. Chance, thanks so much for coming on the show. Fractional losses, kind of a breather a bit, of course, after some decent gains, a relief rally on Monday and Tuesday. What's your current take on the state of the market?
Right now, we think there's still more downside left in the equity market. If you look today, the current valuation is nearly 16 times forward earnings, which is about the long-term average for the S&P 500. And if you look at earnings expectations for next year, investors are anticipating 8% earnings per share growth, which we think is too optimistic. We actually think it's more likely it's going to be an 8% decline in earnings next year rather than an 8% growth. So given those two factors, we would expect that there's a little bit more to go on the downside before you'd start thinking about being more aggressive with your stock purchases.
What's the impetus, Chance? We know that the market is forward-looking. Oftentimes we hear about 6 to 9 months. I think a lot of people, the average American watching the stock market at the start of the pandemic, was wondering, why are we up when Main Street might be feeling some pain? What's the impetus to see a turnaround, an uptrend actually in stocks?
I think you have further to play out with the Fed and other central banks continuing to raise rates. I think people may not realize that that sort of monetary tightening can take up to a year to have a full effect in the economy. So considering that we just started raising rates in March of this year, we've only been doing this for 7 months. The full impact of the rates that were happening even back in the spring and summer have not been fully impacted in the economy yet. So considering the Fed is going to continue to raise rates through the rest of this year and maybe even tighten a bit further early next year, that's going to have an impact on consumer activity. And until you see them start to change their tone and start easing and cutting, it's going to be difficult to get too optimistic about stocks in the near future.
Interesting. So how much further do you think we drop from here? Another 10, 15, 20% in stocks?
Yeah, that could be. If you just look at typical trough valuation in the stock market, when you've had a long-term bear market like this, it usually falls to about 12 or 13 times earnings before you hit a bottom. And typically, if you were looking at the earnings per share expectations for the S&P 500, right now that's about $240 per share is what's anticipated for 2023. That could easily end up dropping to being closer to $200 per share. So until you start seeing estimates come down closer to that level, I don't think you've really baked in a low in the market. And it probably won't be until more like the early part of next year in the January and February reporting period that you'd see more company management teams offer up guidance for 2023 that are lower than what investors are anticipating today.
Okay, so it sounds like you're expecting the worst might be in the first 2 quarters of next year for the economy. Is that the case?
It does seem like if you look at the past 12 to 18 months, employees, workers around the U.S. have not been able to generate wage growth that keeps up with inflation. And right now, they've still been able to spend down some of their excess savings that they received from 2020 and 2021. But once you get through this holiday period, I think the first couple of quarters next year may be real difficult in terms of consumer activity. And you're already seeing that start to trickle in areas that require a lot of financing. With interest rates being higher, it's affecting the housing market. You saw Ally Financial's results today, and Ally's trading down. That's a big impact on the auto financing market. So we would expect that to continue to be a headwind into the first half of next year.
So we've had economists come on the show and they say really this would be a mild recession. If we get one, it's going to be a decline in asset prices, obviously, as we see in the stock market. Businesses making less investments, but not necessarily a complete apocalypse, right? I mean, you're right. We know household savings did increase by more than $2 trillion during this pandemic, but job losses might be ahead. Would you agree that it would be mild, or is this something that should cause a bigger concern for Americans who might be worried about losing their job?
I think trying to determine between mild versus severe in terms of the recession, I don't think that we have a very clear call on that. It's always very difficult to try and predict that sort of level ahead of time. But I think what we can say is that this sort of drawn out bear market and recessionary type environment, that's what we're really looking at here is to just remind investors to stay patient, because it's been nearly 15 years since we've gone through an environment like this, and it's not something that's going to resolve itself in a matter of a few months like we saw in 2020, 2018, or 2011, the past three bear markets before this one.
What are the signals, Chance, that you've been seeing so far? I know we're early on in the reporting season for the third quarter, but it does show that the consumer has been resilient, at least from some of the big banks that have reported, even United Airlines yesterday and Netflix as well.
Yeah, you're getting a mix of different reports. I think United Airlines, for example, their good report came off of what was a booming summer travel season for leisure travelers. Now we're heading into the fourth quarter, where that's more of a time for corporate travel. So it's going to be an interesting test to see how their results come out for the fourth quarter and the first quarter of next year, where it's less driven by leisure travel and more a mix of leisure and corporate. In terms of other areas, Netflix's results, that was more company specific or industry specific in our opinion. Just that shift where they're starting to incorporate more of an advertising model will be better for those companies, because they need to start proving they can be profitable and generate free cash flow. And I think that messaging about generating $1 billion in free cash flow this year and being able to start rolling out the advertising model soon was a relief to investors who've been sitting in that stock this year.
Chance, stick with me. Speaking of Tesla results in third quarter earnings season, we do have an earnings alert, this time coming from Tesla, reporting results just after the market closed today on this Wednesday. And let's take a look at how the company stock is faring in the after hours. It looks like shares down about 4%. The stock had closed fractionally higher, but these losses coming even as the company did exceed earnings expectations by 6 cents, reported earnings per share of $1.05 on earnings per share of 99 cents. Well, sales coming in at $21.5 billion. That was just a hair below the roughly $22 billion that was expected. So I would kind of say that revenue was in line. But one of the notable factors here is that its gross margin did actually drop to just below 28% from nearly 31% on a comparable basis. So less profitable, of course, as costs actually rose for this company and every other company out there due to supply chain issues, as well as simply higher costs for wages, workers, the like right now. The other thing that I will note, free cash flow for the company at about $3.3 billion here.
Okay, great.
In the latest quarter. So Chance, if you're still with me, I'd like to get your reaction to these results that we're getting from Tesla in the after hours.
Sure. Given the results that you just mentioned, I'd say even though the revenue was a slight miss, for a growth company like this, investors don't like seeing revenue misses against expectations. So that may be one factor, and it plays into this narrative that consumer demand for autos is starting to trail off. So that could be one factor. The gross margins that you mentioned, that's another area that's been a real key area of focus. Ford had mentioned earlier in the last few months that they are seeing higher costs that they're having to deal with. Tesla seems like they're having to deal with that as well. And that's a factor for Tesla, because their business model actually allows them to generate higher profit margins than their peers. But if they have to start dealing with higher costs in their supply chain just due to inflation and maybe higher labor costs, that's going to be a bit of a headwind and maybe bring back some of those margin expectations that investors had in their models.
Mm-hmm. Yeah, I see the stock, again, holding on to losses in the after hours, down about 4.5%. Disappointing gross margins, profitability taking a bit of a hit here, even though earnings per share did exceed expectations by about 6 cents. Chance Finucane, Chief Investment Officer at Oxbow Advisors. Chance, thank you.